What I'm going to be showing you today is a very simple Asian session liquidity strategy that I personally use in my trading, and it produces very accurate results. It is very easy to understand and also implement, and hopefully by the end of this video you should have a proper understanding of the strategy so you too can also implement this in your trading and get good results too. If that sounds interesting to you, let's get into it. Now, when it comes to the Asian session liquidity strategy, there are several ways of trading this pattern, or there are several patterns basically on Asian session liquidity. There are basically three main patterns. Now, the original pattern I explained in the first one was you have your Asian session and then you basically have your consolidation, you have your breakouts, you have your reversal, and they end the day back in consolidation. But this pattern is a little bit different. The way this pattern works now is you have your Asian session and you basically have your consolidation as usual. But the difference between this one is you have a breakout out of the Asian range, yes, and then you also have a reversal back into the range. But instead of them continuing up all the way to the top of the Asian range, they basically stop at the middle of the Asian range. It will stop at the middle of the Asian range like this and then reverse back down. So this is basically like a continuation pattern, continuing the trend. And why this works like this, to explain the concept of this, is you basically have your support and resistance. And we know retail traders trade support and resistance, right? So you have your support and resistance here, and then you have your consolidation inside this box. Now, coming into London session, you have your breakouts. And what does this breakout do? This breakout induces traders to enter this on the sell. The breakout traders who trade breakouts out of the support and resistance. Now, in this example, they break out of the zone, they break out of the support, and we know that support someone's resistance once it breaks out. So now this is a resistance, and people are taking this on the sell, right? So now what basically happens is they come back. Why do they come back here? Is because when people sell this breakout, they usually place their stop loss inside the range. This is where their stop loss is usually located. They hardly put it up here. They usually put it up here too, but a majority of traders put it down here because of the low stop loss size, right? So obviously, if you put it above here, the stop loss size is higher, and then that gives you a higher or a lower risk to reward. And then if you put it down here, you have a higher risk to reward. So traders usually put their stop loss here, leave it tight. So the market comes back, hits their stop loss, and then we know that once they enter back into the range, into the support, and then there are traders who might take this as a buy, expecting the breakout, expecting this to be a fake out, and then what they'll do is they'll basically stop at the middle, and sometimes they'll give you an M formation like this, and then they'll continue down, right? The purpose of this M formation in here is to trick the break and retest trader. So someone will take this right here, someone will wait for the retest. So this is the retest that it gets, and then they continue down. So this is the second or the third type of the pattern. I can't remember if it's the second or the third, but there are basically three types, and this is one of them. Now, I'm going to show you a couple of examples of this pattern. Also, this also works inversely like this. When they go out and they come back in, they stop at the middle, and then they continue up in their intended direction. So this whole thing is just a manipulation to mess with the traders. Now, let's go to some examples on the charts. Here I can see a couple of examples. This is live. Now we see here we have our Asian session range happening right here, right? And then what basically happens is they break out of this range from here. You know, this is your support, this is your resistance, and this is the middle of the range. So they break out of this resistance, sorry, of this support, and then why do they head back into the support? Now, look at this. If you zoom in, this is your support level. Now, this is your support level. And we basically see that they close back inside the support level and then they immediately shift away from that level. Why do they shift away from that level? It is because they know that a bunch of stop losses are located in this area, and then which basically means that that is liquidity sitting above this area, which they need to collect in order for them to make this move down, right? So they got a lot of traders in on sells inside here, getting them to put their stop loss in here above the supports, and then they go back, hit their stop loss. Also, the ones who take the breakout, the re-entry back into the supports, also enter trades here, putting their stop loss here, and they hit those ones too. But the majority, the main ones are the ones who put their stop loss in here, and then they make their move back down. That's basically what I was explaining. Now, if you look here, the previous day, you can see the same thing happening here. You have your supports and you have your resistance. Now, what do? They consolidate here. They break out of this consolidation. They break out, getting traders to fall for this sell, to enter trades, breaking on the breakout, and then they enter back inside, hitting the stop losses of those who put their stop loss in here, who took the breakout, and then they move back down aggressively. You see how they shift out of that area with speed and velocity. That is to put them in immediate drawdown. Now, with the previous day, you can see basically the same thing. You have your support, you have your resistance, right? Here we can see they did the usual breakouts and then reverse, and then they hit the stop here too, also inducing traders to take this sell. And because they wanted to continue back down, they had to go back inside and take out the stop losses and then continue down in the original direction. Now let's look at one more example. Let's see if we can find one more example right here. Now we have our support and we have our resistance, and we have this consolidation. We have this consolidation in here, right? Now they break out, getting traders to take this on a sell. Then they go back inside. This time they don't break above the supports. They don't break above. What do? Notice they throw 3 pins or 3 wicks just past this support zone. The purpose of that is to hit all the stop losses here without breaking above. So they didn't want to go any higher. They just wanted to take, it's just like, imagine 3 fingers grabbing the money in here when you stretch your 3 fingers out, right? This is basically what they're doing. This is the smart money or market makers grabbing the money that is sitting above this zone, and then they shift out of that zone immediately and never come back. So there are basically 3 types of this Asian range liquidity strategy. I've explained 2. I'm going to be explaining the 3rd type in my upcoming video. So subscribe to the channel if you're not subscribed so you don't miss any latest content. And also, if you like this video and found this video helpful, hit the like button, turn on post notifications so you get reminded of when I post, and also comment if there's anything you don't understand, or if there's any topic you want me to cover. Also put that in the comments. And if you have not watched the first type, hit this video, click on this video on the screen, and it will teach you how to trade the first type, because you need to understand the first type before you understand this second one that I just explained in this video. So click this video and I'll see you on the next one.